Right. Good afternoon. On behalf of the Institute for Studies in Industrial Development, it is my very great privilege to chair this very important research seminar presentation by two scholars who have made a significant contribution in the area. Professor Subhashish Gupta of the Indian Institute of Management, Bangalore, and Dr. Gaurav Ghosh, currently at JP Morgan Chase. I believe this is based on a paper that was recently published by them in the EPW. And let me just say that the publication of that paper came out in a very timely manner for me, because I had just started teaching the industrial organization course in ISID's new PhD program. And it was a very, very useful summary and critical evaluation of different methods of measuring industrial concentration and the traditional structure, conduct, performance, or SCP paradigm, which has dominated discussions on the effects of industrial concentration for decades, but is now regarded as no longer the appropriate methodology to follow. Of course, the main contribution of the paper is in its proposed measures of concentration for Indian industries at a fairly disaggregated level, 4-digit level NIC. And we look forward to hearing the author's exposition of their results, and then the three very, very distinguished discussants who have in different ways demonstrated their expertise in this area. So the format of today's research seminar is as follows. The authors will get about 30 minutes to present their paper. Then each discussant will have about 8 to 10 minutes to make his or her comments. And then we should have about half an hour left for open discussion from the floor. Members of the audience who would like, before that, I'll give an opportunity to the authors to respond to the discussants' comments. So even so, we should have 25 to 30 minutes for floor discussion, for which I would request members of the audience to either submit their questions on the chat or to raise their hands so as to have an orderly and systematic discussion. So without further delay, let me invite the authors to present their paper on industrial concentration in India. I don't know, are you both going to present turn by turn, or one of you?
Okay. Yes, so I will do about 2/3 of the paper to 2/5 of the paper, and then Gaurav will take over that. So is Gaurav here?
Yes, I think he is.
Okay, should I share my screen, or would you prefer to do that?
Why don't you share your screen?
I'll do that.
Okay, so here we go. So the title of the paper is Industrial Concentration in India. And this is something I've been thinking about for a while, particularly when we hear stories in the newspapers about, oh, there's rising inequality, and then also there's this issue that there's rising concentration. There are, in particular, there are eyebrows raised about certain individuals that who are apparently have their footprint in many industries, and lots of people believe that somehow it is getting more concentrated. So then we thought, okay, is it really getting concentrated? And then the other question which arises, I think, naturally is that, I mean, how do we say this? Okay, fine, it is getting more concentrated than before. That is a reasonable statement, or not, as the case may be. But how do we compare? How do we compare across countries? Can we say that India is more concentrated, say, than the US or China or some other countries? So that was also a question I wondered about. We didn't go that far to sort of do a calculation across countries to look at the, but we sort of said, okay, so here's a question about concentration. Let's see where can we get. Gaurav, can you do the first? Right. So industrial concentration, as we say, has attracted attention in recent years, particularly as a source of inequality. Generally, this issue with inequality seems to resonate all around the world, and in particular, I think I don't know if it is how far it is based on journalism, but certainly on one hand, we see all this the Google, Facebook, etc., people becoming very rich, and at the same time, we have a gig economy where people are apparently not doing very well. So there's a certain certainly in newspapers and it's elsewhere, this inequality issue has been of late quite prominent. Of course, economists have been talking about inequality and poverty, etc., for a long time, but that didn't seem to catch the eye earlier, particularly not in the US and so on. So what we do is we construct HHI index using the CMI Prowess database from 2011-12 to 2021-22. And what we find is a story which is interesting. I mean, firstly, there are differences across industries, which is to be expected. But then there are differences across time. So certain industries seem to go down and then go up. And also how you define a particular industry, that also matters. So if you define it at a very broad level, then of course there are lots of firms, and in which case there's not much. The level of concentration reduces, but as we go into more specific industries, then we find that the level of concentration increases. Also, what we do is that we try to get measures of aggregate indices to see if there's some way we can somehow add together the different HHIs in different industries to come at an aggregate measure of concentration in the country, whether it makes sense or not. So those are issues. And what we find is that by and large, there has not been much difference from 2011-12 to 2021-22. So 10 years, the aggregate index more or less remained the same. Next slide, please. So as we said, remarked earlier that there are growing concerns about market concentration and inequality across the world, and that phenomenon is not restricted to just big tech firms, etc. So we thought, okay, let's see what is the situation with India. And we said, okay, and then we looked at two particular, using the data that we have, we looked into this issue. Next slide. So we measure industrial concentration using the HHI, So analyze trends at different aggregation levels over time and across industries. And we construct aggregate indices and evaluate whether that can be used to measure the overall concentration of various industries in India. So roughly what we have just said. Next time. Okay, so if we think about, so what's the literature like about this, on this? So there are both microeconomic and macroeconomic concerns, and we'll talk about some of these in shortly. And then on top of that, there are industry studies. So people like Kim and Singhal, Nevo, etc., and specific industries like electricity and airlines, and then market concentration in India, where I thought there were two papers which were interesting to us. One is by Binas and the other is by Jacob. So both of them concentrated, asked the same question: is concentration increasing or not, and what is happening? And they found different answers. Next slide. Okay, so the most prominent charge against concentration is that it leads to a rise in market power and is detrimental to consumer wealth. So that would be the very, I think if you were to ask somebody at the level of an undergraduate degree, then they would say, they would have studied and they said, concentration is bad. Why is concentration bad? Because the more concentrated an industry is, the more market power firms out there have. And so the price to marginal cost ratio is likely to go up. So consumers, it's inefficient. The consumers lose out. So that's one approach to take. Now, of course, you have to also bear in mind that at some level, you can make this point, but it really depends on what kind of assumptions you make. What is the model? For example, as we all know, say with Bertrand competition, just two firms will give you an efficient outcome, marginal cost pricing. Of course, again, under very strong assumptions. So yes, this is a charge which can be laid against concentration, but it is not clear as to exactly what is going on. I mean, is it always true? Is it not true? The other approach to take is a empirical approach, and there the standard approach has been to use the SCP paradigm, which is the structure conduct performance paradigm. So the idea is there's structure, which is like it's a monopoly, it's an oligopoly, etc., etc. So the structure determines conduct, how will you price, how will you do things, and that determines performance, profitability, etc. And that, I mean, there is some econometric empirical evidence that yes, in that sense, it is true that the more concentrated an industry is, that it's more profitable. But then, of course, there have been questions raised about, well, in which direction does the causation run? Does structure affect conduct, or is it the other way around? Maybe conduct affects structure and therefore performance. So these are questions on which people have deliberated, and as Professor Bhattacharya suggested that really, I mean, nowadays people don't use the SCP paradigm anymore. But anyway, nevertheless, that was something which was used long ago, 1960s, I think. Other issues, what happens with, does market concentration improve innovation or not? Innovation is seen as different ideas about that. So Schumpeter used to say that his idea was that only big firms will innovate because they can afford, whereas on the other side, Arrow and others suggested competition spurs innovation. People have looked at the issue empirically, and then it's mixed. So it looks like something like an inverse U-shaped. Maybe concentration initially increases innovation and then decreases, or the other way around. Also, there is this idea that increasing market concentration may be the reason behind the certain macroeconomic trends like declining labor share, increasing wealth inequality, and sluggish private investment. So these are, so as we said, that it seems like concentration has been something with which a lot of people are worried about. Next slide. Before going on, I must also say that there's the other view that maybe concentration is also helpful in some ways, and it might be that concentration happens because some firms have better capabilities. If they're more efficient, then typically they'll be able to do better. So there is some bad, there are both sides. Traditionally, we had thought it was bad, but nowadays research seems to suggest it can be both. Maybe it's not necessarily, doesn't necessarily suggest that there's something wrong with the economy. It might happen, and interesting result is that you might see that concentration rises in terms of HHIs, but markups fall. So which suggests less market power in a way. So less market power with more concentration. So that's also an interesting idea. So how do we measure concentration? The usual approaches. I don't think I need to go into that. HHI, of course, the key firm concentration ratio, which says, okay, let's look at the largest 4 or 5 firms and see what is the market share. And Lerner's index, probably the best way to measure market power, but typically very difficult to do because of data limitations. So that is the price marginal cost margin. So this is the HHI, so which you all know. I don't think we'll need to spend time on this. Next. Here is the 4 or 5 firm market share, the formula for that, which again, I'm sure you're all familiar with. Next. And here's the Lerner's index. It's the price minus marginal cost divided by price. Why is it a measure of market power? Well, with perfect competition, price would be equal to marginal cost. So the L would be equal to 0. And the higher the price cost margin, the higher will be the Lerner's index. Next. Okay, so here is where I will hand over to Gaurav, because he will talk about the data and the calculations and deal with the rest of the paper. Right, over to you, Gaurav.
Thank you so much, Ish. And thank you to ISID for inviting us. We hope that you are finding our paper interesting, and hope you'll continue to find it interesting while I'm speaking as well. One point to note is that, as we mentioned, the older framework for looking at concentration was the SCP paradigm. And nowadays, at least among more academic and research-oriented economists, there's not much shift given to the SCP paradigm, but people try to focus on actually measuring, for example, the Lerner index or similar indices despite the empirical challenges that may ensue when folks try this. But it should be kept in mind, and this brings to mind a quote. I don't remember who said it, but it was something along the lines of, how when you look at policy today, you will find the hand of some long-dead economists behind it. And that is kind of true in the measurement of concentration as well, in the sense that the SEP paradigm is no longer considered by practitioners, by academic economists. It's not taught much in, for example, in economic programs. But indices like the HHI and the concentration ratio are still very much used by practitioners in real world scenarios when it comes to trying to figure out whether there is concentration or not in specific markets. Why this might be, I mean, we can speculate about that, and we could spend a lot of time talking about it, but we don't have that much time here. But one reason for that might simply be that these are measures that are quite easy to understand, and they've been in use for a very long time, and so therefore they find continued use today as well. That was just a short note. I'll now talk a little bit about the actual empirical analysis itself, what we did. Broadly speaking, when it comes to industrial studies in India, there are two widely used sources. It's either the ASI data set, which is prepared by MOSPI, or researchers also use PROVESS, which is prepared by CMIE. We ended up going with PROVESS because we found that it contains the relevant variables that we needed for calculating market concentration. So we took a download of PROVESS from the September 22 vintage. We looked at the universe of all firms that were in there over the time period from financial year 2011-12 to financial year 21-22. And then we did some preliminary analysis to see, whether we can use the data as is or whether we need to clean it a bit. One of the things that we did notice was that some firms, for example, would have filed 2 financial statements in a given financial year. And we figured that there's something needed to be done about this, right? Because the HHI, for example, is effectively a summation of all firms within a given industry, right? Their market shares within a given industry. And the market shares in turn are gleaned from their financial statements. And so if we did not remove one of the duplicates, and in some cases there were triplicates as well, then we would end up double counting or triple counting these firms, and they would have undue influence on the overall HHI measure or K concentration measure for their given industry or sector. And so therefore we decided to remove the earlier financial statements for these firms. We also noticed that there were many fewer observations in the latest financial year 21-22 than there were in all the earlier years. And this could be either because firms might not have released their annual reports by the time the September 22 vintage PROVESS release was released, or maybe they had released their annual reports, but they hadn't found their way. The information in the annual reports had not found their way into the PROVESS database as yet. So we removed 21-22 as well. And so therefore, after accounting for potential double entry problems, inconsistent figures, and then missing data on our relevant variables, we ended up with about 2.6 lakh plus observations from around 40,000 companies from 2011-12 to 2020-21. So now we have our data. The next step is to figure out how do we classify our data by industry. What is useful about PROVESS is that all the various firms are classified according to the National Industrial Classification, which is a classification nomenclature that is promulgated by MOSPI. And the structure of the NIC is as follows, right? Right at the top, we have the NIC sections. There are 21 of them labeled A to U, and they are the broadest definitions of sectors in the economy. And they go from, and they include sectors like agriculture, manufacturing, trade, construction, finance, so on and so forth. Under the NIC section, the next level of classification is other divisions, and these divisions are identified by two-digit codes. Like, for example, 02 is the 2-digit code for forestry and logging. And there are, I think, about 71 or 73 two-digit codes under the NIC classification. The divisions in turn are further divided into groups, which are identified by 3-digit codes. For example, 022 is logging. And then groups are further divided into classes, identified by 4-digit codes. For example, 0210 is also classified as logging. And then classes are then subdivided into subclasses, which are 5-digit codes. And so that is the lowest level of aggregation when it comes to the NIC classification system. So now we know what the classification system is that we should be using. We have our data set as well. The next question is, how do we compute the HHI if we were looking to calculate the HHI? Or, for example, the K concentration index if we were looking to calculate that. We would not be able to calculate the learner index because the data available in Prowess did not allow us. Now, the thing about the HHI is that it talks about market shares, right? But it doesn't specify how market shares should be measured. So in the literature, there are two common measures of market shares, right? Often researchers use total income as the measure that will be used to determine market shares. And otherwise, other researchers use total assets to calculate market shares, because both, in a sense, capture the size of the firm. There are pros and cons to using either, whether you use total income or whether you use total asset. In the end, income is a flow variable, and hence it is subject to business cycles. And but on the other hand, because it's a flow variable, it captures a current period snapshot of the firm. So if you're interested in, market shares by focusing on the here and now, then maybe it makes sense to use income as your measure of market share. But there are other issues also associated with using income, right? So for example, if you're a trading firm, you might have a high level of income, but you might have a relatively low level of assets, right? So if you use income, then you might find that trading firms seem to be much bigger than they might actually be given the scale of their economic activity, simply because they have high levels of income, right? One can use assets as well, right? So assets, on the other hand, right, they are a stock variable, and so therefore they provide a longer term measure of market share, because assets, their firms, their income may vary a lot from year to year, but their assets tend to vary less from year to year, right? But one of the issues associated with using assets, right, is that they are often harder to value, right? It's much more complicated to value assets than it is to value income in accounting terms. When it comes to income, there are a few standard definitions that you can use, and everyone uses them, and this is also quite uniform across countries. Assets, on the other hand, not so easy, right? One reason for that, for example, is that for a lot of firms, their intangible assets will be a significant portion of the total value of their assets, right? And valuing intangible assets can sometimes seem more an art than a science, right? Beyond that, when it comes to physical assets as well, the value of an asset is determined often by the depreciation rule that is used to depreciate the asset on the books, right? And depreciation rules will vary from asset class to asset class. It will vary from country to country. It will vary from sector to sector, and so on. And so because of this high variation in depreciation rules, it turns out that similar assets across industries, for example, may have very different values. And so these are some of the challenges that arise when we're using assets to value as a measure of firm size, or indeed in any other study. In the end, right, so there are advantages and there are disadvantages to using either income or assets, right? Income might be better if we're looking for a current snapshot. Assets might be better if we're looking for a longer term snapshot. Assets have more measurability issues, income have less measurability issues. Irrespective, right, if we use income, then we might find certain types of firms like trading and service firms being larger. If we use assets as our measure, we will find firms with more hard assets like manufacturing firms that seem to be larger. And so therefore, what one might also do is then to find some way to combine income and assets. And this is also something that we did in our paper, and our combination was very simple. We simply added income and assets together, and that was our composite measure. I see a comment. Speed up a bit. Oh, sorry. Okay. Yeah, all right. I didn't realize. Findings, right? So what do we generally find? We observe that regardless of whether we use total income or assets, there is substantial similarity in terms of industries contributing to the index to differences that are bound to exist due to the nature of the industries, right? So for example, real estate services are asset-light. We find that market concentration increases as we move from the broad NEC sections, right, to narrow NIC sections to narrow NIC classes. And this is only to be expected, right? Because you have many more firms, yeah, at a higher level of aggregation, and many fewer firms at a lower level of aggregation. But we also do find that market concentration overall seems to be the same or decreasing over the years and across levels. So these are some of the charts that we put in our paper. We're just reproducing them here. We're not going to go through every single chart that we provided because we don't have time, and in the end, a lot of the results actually are quite similar across whether we look at income or whether we look at assets as a measure of market concentration. Right? Overall, when you're looking at sections, right, we see that the larger sections seem to be real estate, water and waste, mining, public administration. The divisions, we have the numbers. I won't go into that right now. Manufacturing classes also, we provided some numbers, 4-digit numbers. Right. The important point to note is that the results, whether we use total income or total assets, fundamentally, they're quite similar, right? In the sense that the same firms that were large when measured by total income are often also the same firms that are large when measured by total assets. Right? So sections like real estate services and water and waste are most concentrated, with HHIs exceeding 2,500 over a decade. Though whether this indicates true concentration in the real estate services is doubtful, as many firms may be too small to enter the Pravas database. So this is one issue we found, right? So we found that certain industries seem to have high levels of concentration. And in the case of sectors like waste and water management, that might make sense, right? Because to be a waste and water management player, you have to be a large organized company, and so therefore you will be in the Pravas database. But when it comes to services, things like real estate services, which include things like brokerages, right? So a lot of all this is quite unorganized and it's done by single individuals. And so therefore a lot of these activities will not be captured in Pravas. There will be very few firms that would be organized enough and large enough to land up in the Pravas database that provide only real estate services. And so therefore, yes, we might have an indication if we only use Pravas data that there is a lot of concentration, but really that is not likely to be the case, right? So this is one of the challenges that we identified when we're using a database like Pravas. Right. Similarly, if we're looking at things like at the 2-digit level, right? Tobacco products, for example, seems concentrated. And this seems likely because, again, to be a tobacco producer, you will have to have a tobacco manufacturer. Yeah, you will have to tobacco product manufacturer. You will have to be at a certain level of scale. Or, if you're extracting crude petroleum, then you will have to be at a certain scale, right? But there are other 2-digit sectors that have high NIC, that have high levels of concentration. But this is more likely because there are a lot of players who are small and unorganized and therefore not in Pravas. Right. So once we had, after this exercise, we had measures of concentration for a lot of different industries at a lot of different levels of aggregation across a large number of years. Our next challenge was to see whether we could aggregate these industries in some way. And so we devised 4 measures for aggregating industries. Right? One is simply to use a simple average, right? So you look at a certain level of aggregation, right? You look at what the aggregation, what the HHI is, right, for all these various sectors. And then you just take a simple average of it. And so therefore you have your measure of concentration for a given year. Right? Otherwise, we can use weighted averages, and we can weight the individual HHIs with various weights. So 3 weights that we considered, right? One was the number of firms in a given sector. Another was the total income in a given sector. And the third was the total assets in a given sector. So what did we find? Right? In the end, we found that simple averages seem to give the highest measures of HHI at the aggregate level. Whereas when we use weights, irrespective of what the specific weight was, right, the numbers that we got were quite similar, as can be seen. And this is true whether we're using total assets to measure HHI or total income plus assets. What is the reason for this? Right, the reason for this is that when we use simple averages, right, sparse sectors, right, sectors like real estate services or waste and water management, are given equal weight to much larger sectors like manufacturing or trading, for example, right? And these sparser sectors and their high HHIs tend to raise the overall aggregate measure. But when we use weighted measures, these sparser sectors get a much lower weight in the overall average, and so therefore the overall aggregate measure of HHI tends to be lower. Right? So to summarize our findings, the market concentration varies by industries and classification levels. Market concentration increases as we consider broader classifications. Overall, for a lot of sectors, we do find that market concentration seems to be decreasing overall. Although for a lot of sectors, we also did find a spike in market concentration in the final year, 2021, which was a COVID year. Right? So if we extend this study by a few years, then we will be able to find whether this increase in 2021 was temporary because of COVID or whether it might be more persistent. At the time of our study, we were not able to make this determination. Right? And overall aggregate concentration measures suggest low, stable concentration. So briefly to summarize our thoughts on the findings, right? Our main motive was to figure out if we can produce a single and consistent measure of industrial concentration in India for comparative purposes. While we have used the HHI methodology, it is possible that certain other measures capture the diverse nature of our industries in a better way. For example, the Learner's Index provides greater clarity on the profit dynamics of industries. We also wanted to take a look at whether we could derive geographical measures of concentration. And we found that Pravas is not the most ideal to do this because often Pravas does provide some geographical information, but often the geographical information will be about the headquarters of the firm, which may be in a large urban center, whereas actual economic activity may not be in that same large urban center. Right? So therefore, we would need more information at a disaggregated level, which Pravas does not have. But for example, ASI might. Right? All right, and some ideas for future research. The variations in certain industry can be due to the nature of entry and exit, and therefore we wish to study specific individual industries to know the forces causing these variations. It would be interesting to see if we could come up with geographical measures, right? And it might also be interesting over a longer term to see whether it makes sense to measure concentration on a year-to-year basis and then see how it changes from year to year. So that's it with me, and I know that we've gone a little bit over time, so sorry about that. And I'll hand it over to Professor Bhattacharya. Thank you.
Thank you, Professor Gupta and Dr. Ghosh. A lot of food for thought there, and I'm sure our 3 discussants will make a feast of it. So the first discussant is Professor Pulak Mishra of the Indian Institute of Technology, Kharagpur, who has published very widely on industrial economics, in particular mergers and concentration. Over to you, Professor Mishra, for your comments.
Am I audible?
Yes.
Yes. Thank you, Professor Bhattacharya. It's an excellent paper presented by both the presenters, and I would like to congratulate them for bringing out a very, very timely work, which can be used in further academic research. Even it can have very, very important insights, particularly in the context of policy making and all. And also, I would like to thank ISID for inviting me and giving me this opportunity to discuss on such an excellent paper. So having said that, in fact, whatever my observations are on this paper, basically to open up some areas. Some of the areas have already been discussed during the presentation, but again, there are certain issues that can be thought of for future research in this line, and also for fine-tuning this particular work, if possible. So the first one I would like to say about the SCP, I mean, relevance of SCP paradigm in today's context. Yes, it is true that this unidirectional relationship from structure to conduct and from conduct to performance, this has been questioned in subsequent research, but at the same time, developments in the literature have also recognized bidirectional causality between, say, conduct and structure, and also between, say, performance and conduct. And more importantly, the subsequent developments have also brought in the implications of policies and regulations in the context of this structure, conduct, performance relationship. So I mean, my understanding is that this SCP framework can still be thought of as the foundation of such works. Of course, some fine-tunings are necessary in terms of measurements of market concentration and understanding their implications, particularly in terms of cause and effect relationships. Second important point is basically the indices that have been used in the paper. Yes, Herfindahl-Hirschman index is quite widely used in the literature, and probably that's a very robust index. But at the same time, I feel it would be better if some comparative analysis or comparative scrutiny is done by using some alternative indicators. If we see the literature basically talks about two different types of measures of market structure. One is the additive measure like Herfindahl-Hirschman index, or say N-firm concentration ratio. The other is basically the inequality measure, like say relative mean deviation, coefficient of variations, etc. And having such comparison is very important because high market concentration doesn't necessarily mean that the market is less competitive. And if that happens, then bringing in price cost margin as an indicator of market concentration may be questioned. In fact, whatever limited works I have done in this line, in one of the papers I have seen that high market concentration doesn't necessarily result in high markup. So, I mean, I think price cost margin or Lerner index can largely be seen as an outcome of market concentration, provided the other impacts, like the impacts of conducts, policies, regulations are controlled. And it can be seen as an alternative, provided there is some degree of comparison across. So I think as a more robust methodological development in this line, it would be better if some alternative measures are also considered, like additive measures versus say inequality measures, and then if we can compare across and see if there is any consistency in the findings. Third is basically the observation in the paper, which is very, very interesting, is that the market concentration has either not changed very significantly or it has decreased. I think while this finding is very interesting, whether that can be really very surprising, in the sense that in the initial years of economic reforms, we have seen some rapid changes in market structure in many industries in the 1990s and also in the first decade of the current century. But probably what has happened over the period of time, the reform programs have matured, policies have been fine-tuned, regulatory arrangements have been made, like say introduction and implementation of the Competition Act. So probably some such market level dynamics, inherent market dynamics, and also certain external arrangements like policies and regulations might have balanced, and probably the changes have also reached certain thresholds. So in the subsequent decade of 10 years that the authors have considered, we are seeing a lot more stable structure in the market. Fourth important point is this data that has been used in the paper. This is simply my query. What would happen if I drop the year, say 2020-21? Because this is otherwise a very abnormal year. So will there be any significant change? I don't think, because this paper basically does yearly analysis. So I think it would be a more robust time frame to consider the period from say 2011-12 till 2019-20 instead of including the year 2020-21. Second issue is many of the firms in Indian corporate sector are quite diversified. So they have presence in multiple industries or multiple segments. So how have the authors taken care of that aspect? Because if I talk about income, whether it is total income or income from a particular segment. Third query would be what type of income has been considered in the paper? Because if I see Prowess data, under income, there are many components. So whether it is income from sales of goods. Fourth is in Prowess data, we see in many of the years, we may find some missing firms, right? So the list of firms in the data set may not be consistent over the period of time. And in Herfindahl-Hirschman index, in fact, we don't control for the number of firms in the industry. So how that issue has been taken care of in the paper. And the other query would be basically a lot of empirical studies that have basically used sales, not income as such. So why have the author considered income instead of sales? So these are some of my queries. And the other point would be basically more of methodological while computing the aggregate indices. If we see Herfindahl-Hirschman index, this can be seen as an weighted average. Herfindahl-Hirschman index itself is a weighted average. When I see market share itself is the weight. So my query would be why absolute number of firms or absolute income has been taken while computing the weighted indices instead of taking the share. So share of a particular industry, share of number of firms of a particular industry in total number of firms, and similarly a share of a particular industry in income. So instead of taking share, why the authors have taken the absolute value of number of firms or income. Thank you. Again, it's a very, very interesting work. And given my limited experience of working in this line, I have really enjoyed thoroughly reading this paper, and actually it gives many, many important insights even for my future works. Thank you. Thank you so much.
Thank you, Professor. Large number of issues you have raised, and I'll certainly be giving the authors adequate time to respond. But I think we'll go through all the three discussants first, and then the authors can respond to them in a consolidated way. Our next discussant is from the home team, Dr. Beena Saraswati of the ISID, who has the rare experience of having a practical experience, having worked on similar issues at the Competition Commission of India, and also her academic work on mergers and concentration. One paper of hers is in fact cited by Dr. Gupta and Dr. Ghosh in this paper, EPW paper itself. Dr. Saraswati.
Thank you, sir. Sir, I'll just share my slide, 3-4 slides. I hope it is visible.
Yes.
First of all, thank you, both the authors, for bringing out this very important issue. I consider any discussion on market concentration and competition is very, very important, especially because the competition policy has a greater role to play in the formulation of industrial policy, especially advanced countries, we are seeing it. So there is a context, and also it has a very important role for we as a consumer as well as a producer, because having a fair market is very important for everyone. So this study, what I found is that I think this study is very important, especially because if anybody wants to say which are the which anybody wants to say which are the quickly respond, like which are the important sectors which are facing competition issues, in that case I think this study is a very important guide in that respect. So that is why I think this is very important study. And also the indicators used in the study is basically the HHI, which is a standard measure. So in that respect also, this is a very important contribution. So, but the study period of this is 2011-12 to 2021-22, but the latest year is dropped to my understanding. So that's why it will be 2020 till 2021. Then from my side, what I'll be discussing this paper mainly from the point of contribution to the policy, data and application, data and methodology side, and also the findings of the study and how it is relevant in the real world situation. So first, from the point of contribution of the study to the policy, I think with the commissions, with the adoption of the competition regulation in India, I think the studies, the way the competition is assessed itself is changing. Earlier, we were dealing with a macro scenario, macro kind of the aggregate level analysis of competition. We were all dealing with, but I think with the commission's implementation of the major components of the competition regulation, I think this is the competition assessment itself is changing so much. And we are going to the narrow level markets. Basically, if you want to clearly establish the competition concern, then we have to deal with the deeper or the much narrow level analysis. So that is missing in this study. And also that kind of an analysis which gives which also consider other factors such as supply side and demand side substitutability, entry barrier, possibility of imports, etc. And those kind of aspects are completely missing in this current analysis. And so I think, like, if we want to clearly contribute to the policy, then we have to do very sector specific studies. That is what now the commission is also doing, to my understanding. So, but I'm not saying that aggregate level studies are not important. That is also important. We all do that kind of analysis also, because we want to know the aggregate level what is happening also. But from the policy point of view, I think this kind of narrow level study is very important. And my second concern is regarding the data and methodology used in this study. I also use PROVERS in all our studies. So that's why I know the limitations of the PROVERS database also. There are so many limitations associated with the PROVERS database, especially if we are dealing with the manufacturing sector, then the coverage of PROVERS database is much better compared to the other sectors like the primary or the service sector. So, but here the authors have used all the sectors, agriculture, manufacturing, and the service sector, all the three sectors they have used. So that's why I think the coverage is a very important issue, especially because for many sectors, there is a huge presence of the unorganized sector. So that PROVERS database doesn't capture. So in that case, so that's why when we are saying concentration only based on the Provost database, in several sectors that may not be the reality. If we consider the unorganized sector also. And then the next point within that is that the study is not making any distinction between primary manufacturing and service sector. Why I'm saying is that the competition as concerns and the way of assessment is completely different for the service sector and also like some of the primary sector, agriculture sector also. So I think, for example, if we take the case of education or health, there is a huge presence of government sector. It may be like often subsidized or freely it may be available. So in that case, you may not get a private sector firms. The number of private sector firms may be very less in that category. So so how do we capture the government investment in that, or the free subsidies provided by the government in that segment? So that's why I think the goods traded and service traded, I think these things should be studied in a different manner. So I think that is missing because the others are taking all the sectors together and doing without giving any kind of special attention to these kind of realities. And also, this point is also mentioned by Pulak sir. That is, Provost classification deals with mainly the others have used the NIC classification. So that is mainly based on the main product of the company. It is not taking into account the secondary products or the other products produced by the firms. And we all know that the most of the firms are having multiple products. So that's why maybe the that one firm may be considered in a wherever the main product is associated with. So other segment they may be omitted. So that's why this may not be completely reflecting on the all products existing in the market. Then another point is regarding the annual financial statement repeated. So basically the authors were saying that in the case of some companies, the financial statements were repeated. But I felt it is a little unusual because normally when we extract data from Provost, that doesn't happen. So I think like we have to follow the standard annual financial statement that we have to extract. So in that case, it normally will not repeat. So that maybe you can check. And also the study period mentioned by the authors is like 2020 till 2022, but authors themselves said that it is the last year is dropped. So in that case, it will be like 2021. So in different places, I have used 2022 as the last year. So another important issue is the missing values. It's also Pulak sir mentioned this issue. So first of all, we are not clear how the authors have removed the missing values. And it is mentioned that 3 lakhs observations became 2.6 lakhs. So, and also like in terms of assets also 3 lakhs became 2.68 lakhs. So, but the major issue, normally if we remove the missing values, it is possible that important information, especially on the top firms, may be removed from the data. So that will lead to when we assess competition, though that top firms may be even removed from the database. So that we need to know actually how the authors have removed this. And also in that case, another important issue may be the concern on the M&As, mergers and acquisition, because when a firm go for the M&As, then after that, normally if the firm is disappearing from the market, normally the financial statement will not be reported. So in that case, again, there will be missing values. And if the firm is removed, in that case, like we have seen through our earlier studies also, like there are in some sectors, even very top firms are being acquired. So in that case, those data will be like completely not capturing from the analysis. This is another issue. And the next issue, again, Pulak sir mentioned this. This is regarding the HHI measured using income. So I think we need to clarify what exactly is the income used by the authors. Is it the income from sales or is it something else? So because the sales total income consists of not only the income from goods and services, it also consists of the other aspects also like rental income and interest, and those kind of things will also come in that. So when we take the market concentration deals with the output traded in the market and which is captured through the value of sales and not income. So in that case, if they are capturing income, then there is a problem. If they are calculating income, then there is a problem there. Now, some of the findings of this study and how it is applicable to the real world. First point is regarding the aggregate concentration. So others are trying to estimate a kind of aggregate concentration for the economy. But what I felt is that market concentration deals with the specific market, basically the product markets, and not with the whole economy. So can we really say that aggregate concentration, like if can we really uh, use one indicator to say that there is a aggregate concentration exists for an economy? I think that's some problem I felt there, and I think if somebody wants to do a such a measure for the economy as a whole, then income concentration, ownership wise concentration, etc. are there that can be tried. I think I don't know whether market concentration can be taken as a indicator for the overall economy as a whole. And another point is use of total income based on HHI does not reflect the income inequality or firm level inequality. That is another important aspect, because if you are thinking like, since you have used HHI based on the total income, so no, it doesn't actually reflect the income inequality or even firm level inequality. Income inequality, if you want to capture, because the paper also mentioning the income inequality, and competition was linked to that aspect. So if you really want to capture income inequality, then we have to consider the the overall income level, and then the various segments of population, and that way we have to connect it. I think this in itself is not sufficient. And firm level, if you are taking also, then we have to go for other indicators, including the ownership concentration and all that we have to check. Then issues like reasons and implications of concentration is more important than aggregating it. And I think rather than finding out an aggregate concentration for the economy, I think what is more important is what are the implications of concentration on the economy, and what are the reasons for that, and those kind of things are more important. And the authors found that the degree of concentration increase as more and more disaggregation is made. I think that is completely expected result, and it is fine with it. And another aspect is on the unrealistic findings on high HHI based on income. Okay, so basically what I'm saying is that some of the findings of this paper, especially on the sectors like real estate, water, waste, etc., and veterinary, then furniture, creative arts, environment, waste collection, treatment, etc., the study found a high concentration based on the income, HHI based on income. So I think if we take the real world situation, that is not exactly the situation. These are some of the sectors which are having very high presence of unorganized firms, and also in some sectors like veterinary, etc., there's a good presence of government sector. So in this market, I'm not sure whether your findings are actually in line with the real world situation. Another, on the mining sector, it is the study found a moderate concentration. But when we have done a study for the mining sector, and what we found is that when we disaggregate the mining sector into different segments, like we did a study for the iron ore sector. So like that, within iron ore sector, we found like different relevant other different product markets exist. So there we found a very high concentration levels actually. So I think these things are we have to consider. Next is regarding the commission itself commission itself undertaken some studies. Very recently, one study on medical devices, and it is found that in the CT scan machines installed in hospitals, GE Healthcare alone constitute 45% of the markets, and Siemens is 31%. So that means the C2 makes around 76%. Like that, in the MRI market, the commission found C3, the concentration of top 3 firms will be around 89%. So these are some of the indicators at the very sectoral level, which revealing the existing high concentration. Also, the commission study itself is finding that. And in our iron ore market study also, we have found around 65% of C4. Sorry, C2. It is basically two government companies, and NMDC and OMC constituted around 65% market share. So I'm not saying that high market share leads to competition issues or not, but that still it indicates that there's a high market share. Then there are some other issues also, like other minor issues, like the study, instead of using 2-digit, 3-digit specification, the study was using some other way of explaining, like second level of aggregation, second lowest level of aggregation, etc. I think from the point of readability, it was not, from the clarity, it was missing. And the period of study I have already mentioned. And another point is regarding the study mentioned that Provost is not reporting physical output and input for calculating markup. So I think this, I'm not sure, I'm not clear. Actually, Provost report the raw materials and other indicators. Then another point is regarding concentration as a source of inequality. So that partially I have mentioned, but there is a statement in this study. India has reported decline in the rate of capital formation over the last few years, and there is an evidence of increasing inequality. Rising market power could be a reason. So I think these kind of things are actually, this is only a kind of statement, and it is not supported by any data. So I think these things saw this, and these are actually, this is also my learning experience for myself. So these are the points from my side. Thank you.
Thank you, Beena. Large number of points there, and I hope the authors can respond. But before that, our third discussant comes from a very different perspective. Mr. Augustine Peter will bring to us his perspective from a practitioner's point of view. He was former member of the Indian Economic Service, and also more relevant, he served as a member of the Competition Commission of India, where he no doubt had to deal with some of these issues, both in merger review and in the antitrust cases which came before him. Mr. Peter, please.
Thank you very much, Chair Professor Bhattacharjee, and congratulations to Professor Subhashit Gupta and Dr. Ghosh. An excellent paper, because I have normally I read hardly once, but this I have read more than once, this paper. So given the rigor and of the paper, the area covered, I find no issue, except yes, there are some small issues which when Pulak comments, then I may not have much to add. And a large number of issues related to competition and related the way Competition Commission looks at it. So Beena has also elaborated. So I don't think I have much left to be stated, because the paper as such given, see data as is available, Provost data, see some time back, maybe 10 years or 15 years back, when we are looking at the data, there were too many deficiencies. Now I think they have been trying, but yes, the time series data may be still inside the newly added items or products or this thing. it will be, see certain things which we cannot do much about that. I remember the days when Amul was not included in the dairy sector because it was a corporate sector and all. So I'm not going into all those type of things. But my only concern with the paper, because I think, see, when a professor of experience standing and a industry practitioner, they come together, they normally put look at all the aspects of an issue, and with the result there is hardly much we can point out from that, because they always, whatever I was trying to say, most of the things they themselves have pointed out. For example, what my main concentration of my comments is, because two preceding commentators have already in detail commented on major issues. So I'll be basically trying to know what is the policy purpose this type of analysis can serve. Because I, being a competition, being in the world area of competition for some time, there is always a tendency to look at from the prism of competition or the glass of competition, whatever it is. See, as we all know, see, there is a provision or Article 39 B and C of the Constitution talks about concentration or the need for distribution, government's duty to ensure that the concentration of economic power doesn't act to the common detriment. So even there, the Constitution doesn't say that concentration is bad in itself. But yes, in the 50s, 60s, 70s, for example, there were a lot of concern, maybe because of the inadequate interpretation of the provision of the Constitution, because to production to the common detriment, the detriment, whether it is detriment or not, that was never looked at very carefully. With the result, there were so many committees, Gajanand committee, that is 1950s, looking at MSMEs and their role, Mahalanobis committee of 59, then industrial policy resolution talking about the need for balanced regional development, Sukumai Chakravarti, then Hazari committee, that is coming in. So with the result, no, we entered in a bit of a mess, because the way those days competition or concentration was looked at was in aggregate level at the national level, without actually delineating the market. That's why we in the Competition Act, as it came, actually it is a modern act, modern practices have been adopted, and delineation of the market going down to a product as well as geographic market, with the result where it pinches. You are big, but that doesn't mean that per se, see, because in the case of MRTP, they were going just by 25% market share, the whole of India, for all the product. Car means all the car. If it is scooter, it is all the scooter. If it is fridge, it is all the fridge. So like that, see, all of India and the products were all same. With the result, there was a feeling. I'm not telling that it was concentration was not there, but that has misled the policy makers in a very great extent. But now, my only fear is that this type of analysis, which says the conclusions are very, actually, to me, in a way, it is obvious, because concentration has remained almost same. And if you go more disaggregated level, then it will increase. That is what the new competition law is also telling. When you go narrower and narrow and define the market, and then see geographically also restrain, then only we will be able to say what is the effect on the market. And second, even if we go by this type of methodology, there is one thing, that is contestability. That is referred to also in the paper, but yes, it was just stated that it is not applicable in all situations. I was trying to see what are the situations where it is not applicable, but I think in most of the cases where it matters, contestability, somebody breathing down your neck, that makes you behave. That's why. So that is one aspect which can be built into this type of analysis. Second, I think the coverage wise, yes, it is basically we are looking at manufacturing sector or industrial sector, but the dominant share now is coming more and more of digital or a digital space service sector like that. No, so I think confining ourselves to this type of database may not be. It is a good analysis. I'm not telling that it is. It is perfect. I find it is near perfect. Every angle has been taken. Indices have been constructed. All those I appreciate excellently very well. But at the same time, I'm telling that when it comes to policy, what is the policy lesson which can be drawn by anybody from this paper? I was trying to see. I am sure that the authors and even Professor Bhattacharya, who is also in this field, he has written some excellent articles in the industrial policy space of India. So now, see, I have also seen that some of the conclusions, it is a bit difficult to believe, maybe because of the period, because already, as it was already stated by the authors, maybe the transformation, most of them took place before the period when we are discussing. Because I think after the immediately after the 1991 liberalization and later, even starting from the late 80s, that is the deregulation period onwards, the transformation had started. But maybe it pettered out or got diffused a bit after the global financial crisis. Maybe I think so, but still I find that in my experience in competition commission, I find that most of the areas, for example, cement, the consolidation is so fast and before your eyes, every day, every month basis. Cement in cinema, for example, film industry. See, in Delhi, you see, it is just getting concentrated. Pharma industry and the banks, even public sector, government is going out of the way. Even in 1991, there was a recommendation for consolidating banks, but those days it was even at the thick of liberalization, this was treated as an anathema. Now you see State Bank of India, all these have been merged now to the and other public sector banks. The tendency is to bring them down to smaller and smaller because coming to the next point, that is efficiency. Schumpeter versus Arrow and parties. So I am not a theoretician, but at the same time, I know that Schumpeter has got relevance even now, I feel, because innovation requires size. That is the learning which we are getting, and also there is. I think all of you in the academic field must be knowing the rule of three. There is a tendency for industry, certain aviation. See, there were so many players when we started. Where have they gone? They have disappeared. In a network industry, in a service industry, many of them, there is a tendency for the players to be left out. They will be in competition, they will be just left out, and ultimately in a market, relevant market, ultimately two or three remain. It is the case with telecom. You see how many players tried, even the gigantic Birla and Idea and all, where have they gone? So it is extremely difficult. Competition gives benefit to the consumers, it brings down price, but at the same time thinking that size or the concentration is per se bad, I think that conclusion will mislead the policy makers. This is the only point I would like to make. Otherwise, analytically, the objective of the paper, what it was intended to serve, it must be serving. And I have no doubt regarding that. I have no objection or any serious issues with the paper. But only thing is that whenever we, the authors who are very, who are very prominent researchers and with a lot of experience, when they do further work, I think contestability. How can we, for example, in the Competition Act, as Bina was also pointing out, import competition is an extremely important this thing, because at a time when competition law that committee report, Raghavan committee was being discussed, a group of prominent economists in India were telling what is the need of this, another MRTP in a different form. you liberalize import. So import competition, when import competition is possible, then is made possible. So that contestability aspect, then there is the resources, a lot of other factors are also taken into account. I'm not going more into it. I'm only highlighting one aspect, that the utility for this type of analysis for policy making, that I think we should keep in mind. It should not end up misleading, because many of the politicians may not immediately understand the implications. So that is only one aspect. Otherwise, I am very happy with the paper. It reads excellently well. It is well organized. Thank you very much. I will be available if there is any contribution to be made. Thank you.
Thank you, Mr. Peter. Well, thanks to all these very detailed comments, we are really very hard pressed for time now, but of course one must give the right of reply to the authors. I also had many comments, but I think my role is mainly that of chair, so I shall hold them back. Most of my comments have been put forward by the other discussants, in particular Dr. Bina's, that is especially the fact that it is really share of sales at a much more disaggregated level, which is relevant for measuring concentration from the perspective of policy. And the other small point I would like to make is so many missing values. I said our PhD students, I gave them this as a required reading, and also asked them to do some calculations as a term paper. And they pointed out there are severe gaps in prowess. For years at a stretch, firms just disappear in the database and then reappear, which means any calculated HHI will show artificial fluctuations simply because of lack of reporting. And the other hand, there are some consistent missing firms. I don't see how, for example, sector 1900, coke and refined petroleum is showing monopoly. That is 10,000 HHI for all years. Now we know Reliance is very big and dominant, but it's not a monopoly. It means that most of the firms are not even being recorded in that sector. Similarly, 2300, they show monopoly, non-metallic mineral products. What are non-metallic mineral products? It includes all glassware, including glass bangles, glasses which we use for industrial applications, glasses we put on our dining tables. So is that a monopolized sector in India? So I think one has to really look at prowess very, very carefully before coming up with such calculations. Anyway, so let me now hand over to the authors for their response to as many of the comments as they could. I'm sure they need to think about many of the comments to leisure and maybe get back to the discussants separately, but please go ahead. Maybe in about 10 minutes, you can.
Right. So I think we have received fair number of comments. To do justice to them all in 10 minutes will be a little difficult, but we'll try to do that. So generally, I think data issues will be handled by Gaurav, and I will talk about some of the other issues. Start with Professor Mishra about the relevance of the SCP paradigm and that the causality might be bidirectional. Yes, very much so. I mean, even though SCP somehow has become, it's sort of become irrelevant by fashion, not necessarily because it's not useful anymore. Somehow, it's like if you do this, then you are no longer doing the best analysis somehow. So I'm sure if one looked at, you could find lots of casualty in many different directions, I'm sure. Alternative measures, certainly, we had earlier thought that we would sort of use learners index, but for there certain problems trying to measure learners index, so we said, okay, maybe later, not now. Coefficient of variation. Actually, long ago, I actually wrote a paper study for the Competition Commission of India about the telecom sector. And those days, of course, there were so many telecom companies. And there we said that there are many many measures of competition. You can talk about entry and exit rates, essentially, there's nothing called competition as such. There's rivalry, right? So trying to measure competition is necessarily difficult because you don't know what is it that you are measuring. So measuring something a little nebulous. So it can only be measured indirectly. So there are a large number of such measures, and yes, we could use some others. Why did we get the results? Did we get that there's not much has changed over time? So we have wondered about that as well. And so, as some people have suggested, maybe there was a certain amount of upheaval at the time of liberalization, and I'm sure there's a fair amount of churn in the number of firms, consolidation, and so on. But it seems to me, at least within the time period we've considered, that overall, it seems to me that the industrial sector has pretty much stabilized. There's nothing much happening out there. Now, whether that is just a facet of the data, or is that really true, or is it just because of methodology, because we have added up the whole economy as it was, and presumably economies are like ocean liners. They move very slowly and things don't happen much. So it's an issue. Yes, we are worried about that, because at some level, I would go further, because if this is so, then what does it imply? Which might actually go to answering Mr. Peters' question. What is the policy implication? One way to look at it is to say, well, right now in terms of concentration, nothing much is happening. For the last 10 years, it's not lowered, it's not increased. So things are good. That could be one thing you could say. Other than that, you could take the opposite view and say, no, see, everything is, we want competition, and overall the concentration should decrease, because that will show that there is less the government's policies should be such so as to reduce concentration. I don't think you can make that point if you look at the overall economy, but nevertheless, I thought this was something which was interesting to do. Actually, once upon a time, I still have that book. There's a book on the Japanese economy, and there what they did was they looked at concentration by industries in Japan, various industries in Japan, and various industries in the US. And then they drew a 45-degree line, and you could see that in most of the industries, Japan was on the right side, that it was more concentrated than American. So something of that sort might be more interesting than to provide one figure. That's about Dr. Mishra, Professor Mishra. Dr. Bina made a lot of, Professor Bina made a lot of points. One was that it's too broad. Yes, we agree. But we were trying to answer that question, which was nagging us. Has concentration really increased in India? Because that seemed to be something which that was a vibe which was going on, and I don't know if it did. Well, that was a feeble attempt. Again, issues about aggregate concentration. Yes, true problems. I mean, we said that, look, we are doing this, but you're not very sure what you're doing. And of course, can you aggregate at all? It's like adding different things, oranges and lemons. So yes, problems. This thing about the physical output, that was the problem we had when trying to calculate learners index, because most people, if you look at the papers by Delokier and others, what they do is they calculate the learner's index indirectly by using output elasticity. And then because they do not have, often databases don't have results on data on output, so apparently a lot of studies have used revenue elasticity. And then there's a paper by Bond and others which show that if you assume profit maximization, then if you use the particular measure that is being used, revenue elasticity divided by the share of the costs for that particular input, that it is identically equal to 1. So whatever you're estimating is kind of wrong. So we said, okay, we'll need to look deeper into that. And after that, there have been several other papers trying to fix that. So that's something we'll keep in mind and see if we can do that. I think that's all I have to say. I'll leave it to Gaurav to add his bit.
Yeah, so that's one. So coming to the results of the bond paper, I mean, what we found in Prowess was, yes, there are monetary values of raw material and so on, right? Which we could have used to calculate revenue and elasticities. But given the newer literature, that did not seem the right way to go about doing it. And so therefore we did check in Prowess whether they had, actual physical measures of inputs. And that was severely missing. I think so. Maybe as much as 95 or 98% of the observations would have dropped out if we focused only on physical measures of inputs and outputs. So in which case, that entire study would have been, the study itself would not have been possible with Prowess. So we did consider it. We were aware of the literature. It was just not feasible given the database. As to a lot of the other issues with Prowess that were pointed out, these are not, a lot of them were not new to us. We were aware of them as we were going into the analysis. So this question of the missing data, right? This is something that all our discussants have pointed out, right? And this is something that obviously is important, right? The question of whether it's important or not depends on whether the data is missing at random or whether it's not missing at random. We did spend a few months looking into this, and there are interpolation methods that you can use to kind of interpolate out observations in missing years. And so therefore, if you have data for say 2015 and 2017, then you'll find some way to interpolate out for 2016. But as was pointed out, right, like with a lot of the observations, you would have data that would be missing for a long period of time. And given that the data set itself, the time period itself is only 10 years, using imputation methods, interpolation methods just did not seem to make sense. We could have had some sort of linear interpolations, but that would not really reflect, patterns of sales or patterns of assets across, in specific sectors. So, it would have been a big exercise to do to deal with these kind of missing issues. But given the way that the data was missing, we figured that in the end, we would still not have been happy with the results. So then the question is, what do you do? Right? So one of the things we considered was, if there would be a firm that would be missing for a couple of years, then maybe we need to drop that firm. If we did that, then once again, the size of the data would shrink. And the other option would be the interpolation, right? To figure out how do you, figure out what those missing values are. How do you do the imputation? As I said, we spent time on this. We didn't come up with a satisfactory way to proceed on this. And so in the end, I guess we took the easy way out, which was to just, cross our fingers and, hope that the data was missing at random. It was not, but nevertheless, we figured that, some sort of flawed estimates might be better than no estimates at all. This again, it's in the end, you work with what you're given. And yeah, it's not satisfactory. If we could have found a better way to deal with the missing data, we would have. We just did not. We did take a look at it. We could not find something that would have been, completely satisfactory. There was questions were again raised about how do you deal with the fact that, and this again, I know Professor Mishra raised it, Professor Beena raised it as well. How do you deal with diversified firms, right? A lot of firms are multi-product firms. This again, in principle, you can deal with if you know exactly what the products are for these various firms and what the specific revenue streams are that accrue to these specific products. Prowess does not have that data, so it's not possible to make these kinds of carve-outs. In the end, from our reading of the documentation, what Prowess does, what we understand Prowess to do is that they impute the industry to the major product. And, we went with that definition. Once again, it's not wholly satisfactory. We were aware of the issue. We did not, in the end, deal with the issue when we were doing our calculations. I'm looking through my notes. Yes, there was again, all Professor Bhattacharjee and all the discussants pointed out that, a lot of the HHI numbers are not reliable, right? Because of the fact that firms might be in the unorganized sector, right? Or for some other reason, firms are not appearing in the Prowess database, right? Dr. Peters pointed that out, in the context of Amul not being there in the dairy sector. Dr. Bhattacharjee talked about, Reliance not being a monopolist in, petrol and refining. Dr. Saraswati, pointed out that in many sectors, including real estate, there is a large unorganized sector. Agriculture is a large unorganized sector. Once again, right, these are things that we are also aware of. And, at least as far as the unorganized sector comment goes, this is something that we did discuss today, and we also pointed it out in the paper. The upshot is that, yes, indeed, a lot of the measures of the HHI are, using Prowess are problematic. And they are problematic because not only is there missing data, but we also don't know how much of that data is missing, right? So, so for example, if we're looking at, something like real estate services, then, clearly, we're finding high levels of concentration, but that's because there are very few real estate services firms that have actually landed up in the Prowess database. And then you have, most of the sector being unorganized. But that is not helpful to us because we don't know what the ratio is actually between organized and unorganized. And so therefore you can't even do some sort of imputation to say that, okay, how much should we scale down the numbers for? So yeah, the points are absolutely true. We recognize them. And, in the end, once again, we figured that it's better to at least see, what are the kinds of numbers that we can come up with. and then caveat it and say that, look, yes, we are getting these numbers, but we need to be aware that, the numbers may not be reliable for such and such reasons, which we did, point out. And is this satisfactory, right? Don't we hope for greater levels of precision? Don't we hope for greater levels of, reliability? Yes, we do. But, in our mind, we were also kind of demonstrating that, in the end, we don't have that many data sources when it comes to looking at, Indian industrial structure. And one of them, we did use one of them, and we did find out that, in the end, yes, we're able to get numbers, but the numbers are not satisfactory because of questions of things like coverage. Right? There was the question of why did we not use sales instead of using income? Instead of using total income. I think we'll have to take a closer look at this because I could be wrong, but I think the measure that we were looking at was an income variable that in effect was capturing the sales revenues of the firms. But now the details escape us. Escape me. The analysis was done a while ago. Beyond that,
we are actually running out of time. We are out of time, so it's just maybe one more
okay.
point.
Yeah. So thank you for pointing that out. I do see that it is 5:15. I will, end my comments out here, and I'll just reiterate that yes, a lot of the data problems were things that we were aware of. A lot of them, some of them were mentioned in the paper, some of them may not have been mentioned in the paper, but we did encounter them and we were aware of them. So thank you to the discussants for taking the time to read our paper so closely and give us such detailed comments. Thank you to Dr. Bhattacharjee for chairing this session. Thank you to all the viewers who sat with us through all this time and listened to us talk about our research and listen to the critique of our research. It is much appreciated. I hope that you all have found this a useful way to spend a Friday afternoon, and I do wish everybody here an excellent weekend coming up. Thank you so much.
Professor,
Thank
can I just raise one small query?
Very quickly.
If you have time, just in a few seconds. Is it possible?
Yeah, please, quickly.
Dr. Ghosh, the point that I was trying to raise, when you are making this weighted average, Harvinder-Leachman index has the weight of share itself, right? And when you are aggregating, then you are using basically share in terms of labor, number of firms or income. Why didn't you use the same weight in terms of converting farm level data into industry level index and then converting industry level index into, say, aggregate index? Because at
Right, so
level, yeah,
doing the weightage when going up from say the 4-digit level to the 3-digit level to the 2-digit level. That's what you're saying.
Exactly.
Right, that is a good point. I don't remember now exactly what our thinking was at that time, but that is a good point. It would make sense. I think we'll have to take a look at that more closely.
Because when you are using a total number of firms in an industry, actually it is giving equal importance to all the firms in that industry.
Yeah, I think he pointed that out. Only thing is the justification, and as he says, they may need to think about it more.
Yeah.
Now we are really out of time, and I see we're losing the audience also, and the numbers have been falling. So let me just conclude, and we could not invite audience questions and comments. So anyone from the audience who had any questions for the authors, please write into them directly. Their paper was published in the Economic and Political Weekly in January, and their email addresses are, as usual, given at the bottom of the first page of the article, and I'm sure they would be happy to respond. So with that, let me thank the speakers and the discussants and members of the audience. Today's session has really been very informative and useful for all researchers who are working on this area in India. And if people raise problems and difficulties, that is in the nature of doing empirical research in this area. It can never be a perfect job because of the limitations in the data. But we have to keep trying and doing the best we can. And so this paper represents a step in that direction. So thank you all very much. With that, we bring to an end today's proceedings. And we hope that members of the audience will continue to check the ISID website for future research seminars. Thank you.
Thank you.
Thank
Thank you, sir. Thank you, everyone.
you.